The People's Republic of China's role as a substantial holder of US Treasury securities propelled the nation's economic ascent, largely driven by its significant trade surplus. However, despite its meteoric rise, China found itself in the throes of an unexpected financial shift. This economic powerhouse, renowned for its substantial investments in sectors from technology to manufacturing, soon found itself navigating a turbulent sea of changing economic strategies. By the close of 2022, the reduction of China's holdings in US Treasury securities, once a pillar of its foreign exchange reserves, cast a long shadow over its previous dominance in this sphere. The repercussions echoed far beyond its national borders, leading to critical decisions on international economics and stirring debates on the challenges and intricacies of the Sino-US financial relationship. To understand how important this is, we must first go back to the basics. As of 2022, China's holding of approximately $1.06 trillion in US Treasury securities marked a significant decrease from its peak in 2011 at $1.31 trillion, reflecting a critical component of its macroeconomic strategy. These securities represent the US debt, the funds borrowed by the US federal government to cover budget deficits, issued in the form of treasury bills, notes, and bonds. China's investment in this debt is part of a broader strategy tied to its foreign exchange reserves, the largest globally at $3.2 trillion as of 2022, according to the International Monetary Fund. These reserves, more than double that of the next largest holder, Japan, are held in a variety of assets, including gold, special drawing rights or SDRs issued by the International Monetary Fund or IMF, and foreign currencies. Investment in safe and liquid assets, such as US Treasury securities, ensures these vast reserves yield returns, serving a dual role of financing the US budget deficit and maintaining low interest rates that encourage American economic growth. China's accumulation of these reserves is a direct result of its significant trade surplus, generated largely by exporting more goods and services than it imports. As Chinese companies convert export earnings in US dollars to yuan at the People's Bank of China, the central bank accumulates the US dollars, forming a major part of China's foreign exchange reserves. China's entry into the World Trade Organization in 2001 amplified its trade activities and subsequent reserves, further boosting its investments in US debt. This mutually beneficial arrangement, however, is not without complexities and controversies shaped by factors such as economic policies, exchange rates, and geopolitical dynamics. Despite the benefits, China has begun to reduce its US debt holdings, a shift that we'll further explore in a later segment of this video. China's investment in US Treasury securities, a safe and liquid asset, is a strategic decision motivated by several factors. These include the perceived security and trust in the US never defaulting on its debt, the liquidity of these assets for quick fund release if necessary, the balance it offers to keep China's currency, the yuan, weak relative to the dollar, benefiting the country's massive export industry, and the interest earnings from lending to the US government. However, recent years have seen a notable shift as China began reducing its treasury security holdings, a decision influenced by a range of factors. The rising political tensions between the US and China have inevitably spilled over into their economic relationship. Simultaneously, China's transition from an export-oriented economy to one emphasizing domestic consumption and services, its dual circulation strategy, lessens the need for US dollar accumulation, thereby reducing its investment in US Treasury securities. Currency dynamics also play a role. China manipulates its foreign exchange reserves to manage the yuan's value, purchasing US dollars to keep the yuan from appreciating too quickly, or vice versa when it aims to support the yuan. Recent years, however, have seen less need for such interventions. Lower yields of US Treasury securities compared to other investment options, prompted by historically low US interest rates, have likely motivated China to seek higher return assets. Additionally, concerns about the US's long-term fiscal health, amplified by escalating public debt, have introduced a potential risk China may no longer wish to bear. These reasons contribute to the reduction in China's US debt holdings, although it's important to underscore the complexity of this decision. A blend of economic strategies, currency management, risk diversification, and geopolitical factors, among others, guide China's actions. In our subsequent discussion, we'll delve into the potential ramification of China's decreased US debt holdings for the global economy. Despite the advantages of holding US debt, China has been steadily reducing its stake, with its holdings falling below $1 trillion for the first time since 2010 by November 2022, according to CNBC. This change could be attributed to China's strategy to diversify its foreign reserves, ongoing geopolitical tensions and trade disputes with the US, or domestic economic considerations, such as maintaining the value of the yuan or stimulating its economy. In our ongoing discussion about China's US debt holdings, it's important to consider the potential implications of this reduction. While it's theoretically possible for China to abruptly sell off its vast US debt holdings, causing a substantial economic crisis in the US, such a scenario is highly unlikely. A sudden large-scale sell-off would devalue these securities and cause China to incur significant losses on its investment. Furthermore, such a move would likely lead to a spike in US interest rates, potentially triggering a global financial crisis, which would also impact China, one of the US's largest trading partners. However, the gradual decrease in China's holding of US debt could still bear consequences, although they would likely be more subtle and long-term. If China, along with other major foreign debt holders, continues this trend, it could exert upward pressure on US interest rates, potentially inhibiting economic growth by making borrowing more costly. However, the Federal Reserve has the capacity to intervene, buying treasury securities to maintain low interest rates, a strategy employed during the COVID-19 pandemic. Ultimately, China's reduction in US debt holdings reflects a larger trend of countries diversifying their foreign exchange reserves away from US dollar assets. In the long run, this could gradually erode the US dollar's dominance as the world's primary reserve currency. Now, finally, before we end, let's discuss the financial interplay between the world's two largest economies, the US and China, as it creates a symbiotic relationship surrounding debt. The US benefits from China's purchase of treasury securities through low borrowing costs, facilitating budget deficits, funding and fostering economic growth with low interest rates on loans ranging from mortgages to businesses. Concurrently, China leverages its US debt holdings to manage its currency, the renminbi, aiding the competitiveness of its exports, and provides a low-risk approach to managing its immense foreign exchange reserves given the perceived safety of US treasury securities. Nevertheless, the future holds uncertainty. Escalating US-China tensions have cast doubts over the sustainability of this relationship. China's decreasing US debt holdings align with its strategy to boost domestic consumption, signaling a potential desire to diversify its foreign exchange reserves and lessen reliance on US debt. Meanwhile, the US is pressured to curtail its budget deficits and national debt growth, a complicated task if major foreign debt holders like China continue reducing their holdings. In this evolving dynamic, US debt's role is also likely to transform, creating a compelling economic narrative in the years ahead. The financial independence between the US and China, a reflection of our globalized world, ensures that one nation's financial decisions have a global impact. The implications of China adjusting its US debt holdings could affect US interest rates, and, by extension, economic growth. Though an en masse sell-off theoretically driving up interest rates is highly unlikely due to the devaluation risk of China's remaining holdings. China's US debt holdings also provide a certain degree of leverage over US fiscal and monetary policy, albeit often exaggerated. Any substantial disruption in this relationship would also negatively affect China. As China's global economic influence grows, it may wield its considerable US debt holdings as a foreign policy tool. The nations' mutual economic interdependence could be a stabilizing factor, deterring conflicts that could disrupt their economic relationship. However, geopolitical disputes may escalate, leveraging their reciprocal debts as negotiation instruments. It's crucial to remember that China's ownership of US debt reflects the trade balance between the two nations. Any significant steps by the US to reduce its trade deficit with China could potentially lead to diminished Chinese purchases of US debt. However, modifying these trade dynamics entails a complex process with far-reaching implications for both economies. But anyway, do let us know what you think. Thanks for watching.